Good day, fellow investors. We discussed Aker BP and there were many comments on why not analyzing also Equinor. As I'm looking a little bit into the sector for my diversified portfolio, why not? So we'll discuss Equinor. The stock price is a little bit lower, so nothing wrong with stock prices lower, but also we have to discuss the possible oil at 50 scenario, how it will impact Equinor, Exxon and other players there, which will make this, I hope, an interesting video, so smash that like button if you enjoy these videos. Let's do the business overview, the oil factor price analysis to see where are oil prices going, which impact consequently cash flows, distributions, valuations, and long-term stock prices. Even if some stocks are hanging that high, but they will get hit by reality. And then we'll conclude with an investing strategy because that's what you need when it comes to the current situation. If I look at Equinor, their expected free cash flow from their capital update day is 23 billion in 3 years, that's 7 something billion. But based on a reference case of $70 per oil barrel, we are now at 60, thus we must expect lower, and we'll also dig into the sensitivity of that. They are targeting portfolio growth, investments, also reduction of CO2 emissions, so very ambitious. They are also investing in renewables. There have been some setbacks now in the US due to some new regulation, but all in all, they are investing significantly, growing production, and expecting a 9 billion capital distribution this year. If you put 9 billion on the market cap and perhaps as oil prices go lower, that is already around 15%. 10% dividend yield plus the strong buybacks that they have already been doing this year. So the 5 billion share buyback and the quarterly strong dividend. Of course, when oil prices were higher, they distributed staggering $45 billion over just 3 years. Their outlook is for stronger cash flow outlooks as they manage that capex if again oil prices stay at 70. But you can see here, this is the cumulative expected cash generation. If oil prices are higher, then the surplus cash will be significantly higher than the base dividend and the capex, thus also for their target buybacks. Of course, this is mostly Norwegian oil, thus low-cost production is the key in whatever environment. They should remain profitable. If oil prices go lower, taxes go lower, and therefore they can survive whatever. And they also have this very strong European gas exposure. So if European gas prices are higher, they also make significant money. And they have made 2 billion, actually 4.5 billion in cash flow also this first quarter thanks to higher European gas prices. Now, this is the summary. In the conference call, they have committed to the 9 billion distribution, and there were also questions about that, but you can see here net debt ratio below 7%, thus no issues there. They are profitable in whatever oil environment due to the low costs. Here we have also a sign of the impact of the uncertainty raised by the US administration. So they have invested approximately 2.5 billion in Empire Wind. They have get the approvals, and now they have seen that reproval removed by the government, as likely Trump is going against renewables. So that's life, but this also shows how negative can also be the change in policy that comes immediately and then it shocks businesses. The next time businesses will wait before investing, and that is the long-term, let's say, cost of this uncertainty in the current business operation related to the US tariffs and things, that the cost will be paid only in the future, long after Trump is gone. But okay, the questions are, is the 9 billion safe regardless of lower oil prices? What is their prediction for oil prices? How can they talk about it? And they don't say that they can predict oil prices, of course, but they say this, that if oil goes to 60 and $2 per lower gas prices, that their cash flows go from 20 to 18 billion. So nothing wrong there. Thus, their distributions go from 9 to 7 billion. Or if oil prices go to 40 or 50 and even a little bit lower natural gas, then still you get, in the worst case scenario, at least 5 billion of distributions. Of course, they have benefited from the situation in Ukraine and Russia, no Russian exports to Europe, so natural gas prices are significantly higher than what they used to be, and therefore they are benefiting from that too. And then your new projects are break-even even below 40. Can you discuss that? And here is the key sentence. We are prepared for significantly lower prices than we see currently. So they have learned that they have to be prepared also perhaps for oil prices at 40 for longer. They have this buffer. You see here, their money making, so they make 7 billion pre-tax, then they pay the taxes and 1.6 is left. If they make 3 billion, then still there will be almost a billion here left for taxes. So not a big difference on big changes in oil prices due to the tax system in Norway. So at these levels, if you're expecting a long-term 10% return, you can just expect a 6 billion dividend, and that is 10% from here. And given the situation, given the quality of the business, it's not unlikely that that will happen. Of course, on the stock price, the key factor are oil prices, as always. I've looked a little bit, and JPM has lowered their expected oil prices to 66 in 2025, 58 per barrel in 2026. On Trump administration continues to prioritize reducing oil prices. We have seen the deals with the Saudis and things like that. And they are then getting higher production, higher supply leads to lower oil prices. And they will not intervene at oil prices below 50. So that is something that is necessary for lower inflation. Here is the impact on inflation globally, 1.5 percentage points lower inflation due to lower oil prices. However, with oil prices below 50, Trump might succeed in successfully destroying the US oil industry, because many companies like Occidental that we discussed have a break-even at 60, thus at 50, less investments in the future, things like that. It again might be a double-edged sword. Equinor, no problem, from 9 billion we go to 5 billion as we discussed. Good returns there still. We have to also understand the long-term situation there. When oil prices are high, usually leads to low oil prices. Low oil prices, this is great to explain here on the stock price, because leads to higher oil prices, low oil stock prices. And then that is the cycle that you can see here happened 1, 2, 3, and now we are in the 4th time over the last 20 years. So it takes 5 years for that oil cycle to develop. Of course, some people, especially US markets, haven't yet been hit by reality. So if you want to short something, this is Exxon, for example, is the one to short, especially with now interest rates. And this might be the topic of 2025, not tariffs, but higher long-term or higher yields on US debt. Less activity, less this, so that might be an issue. We'll discuss this in a special video. Also, I found the research here that only 20% of the leading Canadian companies, for example, can sustain longer-term 50 oil prices. And here is the research conclusion. So especially those with high debt ratios, will be vulnerable. And then you see that also stock prices might be hit. But that is the cycle, and that is the cycle I always look at. We have been pretty prescient in 2020 in September when oil prices were ridiculously low to invest, make some money there, nothing wrong there. However, that is the cycle 2020, 2024, 2023 high prices. Now we are again in low price territory. If there is a global slowdown, recession, this or that, it might take longer, but that is how oil prices and the oil cycle works. If I look at Equinor, we have discussed Equinor, so Equinor a little bit more risky because of their global exposure, higher costs of the, 25% of net income and things like that, also renewables. And there was a question also discussing how international competitors are more diversified, but when you're in Norway, that is a negative, not a positive. Here you can again see higher oil prices lead to low oil prices. Okay, a little bit higher. This was the pandemic, but that low investment and everything led to high oil prices, and now we are going down for even lower oil prices. When it comes to portfolio strategy, if you have low-cost producers, they will keep paying the dividend. You can then reinvest at that position, and then in the next oil boom price cycle, you can discuss whether sell or not. But you need to be patient. Of course, if oil prices go lower, also stock prices will go lower, but then you will be able to buy more with the good dividends that some players will still be paying. So accept volatility. Volatility is usually the friend of the value investor. You can own more, the buybacks with lower prices get more value to shareholders. So very interesting oil situation. Personally, I feel that we have not yet seen the lows, especially if there is a recession, US recession, global slowdown, things like that. We might see 40 oil for 2026. That would be extremely detrimental to stock prices. So always think of it as small current portfolio exposure, because we are now there on the long term, 10-12% long term returns. Not bad, but usually cyclical. Sometimes in bad periods you can buy them at 20% returns. So start with a small position just to keep your mind exposed to the idea. Then if it goes lower, we'll act and then buy more, increase the oil position when it gets us 20% returns over the cycle, when the cycle booms, because that's natural. They don't invest, they have less cash, oil prices then, as things rebound, boom, and we make money over that 5-year cycle. You can check my research platform. I'll likely add some more oil players to the diversified portfolio, and then we'll play the cycle, make some money, standard as we have done in the past.